SP minus AP. AQ into SP minus AP. So here what is happening? Actual quantity into standard price minus actual price. So here material A actual quantity is 1100. Actual price is 2 rupees. It's 2 rupees. They kept comma, but it's a point, 2 rupees. And actual price is 2 rupees 25 paisa. So 1100 is the quantity, actual quantity. 2 rupees minus 2.25, it comes to minus 0.25. And it is a 275, it is adverse. It's negative. Next here is material B, that is 1400 quantity. Actual quantity is 1400. Standard price is 3.25 and actual price is 3.50. So again we got minus 0.25. So again we get an adverse of minus 350. Next is material C. Actual quantity 2000. Standard price is 3 rupees and actual price is 3.75. And material standard price, actual price is 3.75. So you'll get again adverse of 0.25. So you'll get 500 adverse. So overall we get material price variance is 1125 adverse. It's a negative one. Next we have is material usage variance. Under material usage variance, the formula is standard price into standard quantity minus actual quantity. So standard price is 2 rupees in the case of material A and quantity is 1050 and actual quantity we produced is used is 1100. So we got again adverse 100, negative balance. Next material B, standard price is 3.25 and the standard quantity is 1500 minus actual quantity is 1400. So we'll get favorable. This is favorable. Favorable 325. Similarly, with respect to the material C also we get favorable. So overall we got favorable 625. So it will be, sorry, 675 and adverse is 100. So overall we get 575 as favorable balance in case of material usage variance. So altogether material cost variance is equal to material price variance plus material usage variance. You will get that same. Similarly, we do with the all the, if any, there it was ABC, now it is XYZ. This is about material cost variance. Now we look at the labor variance. So we have seen material cost variance, usage variance and price variance. Next is direct labor variances. Under this, we will discuss about labor cost variance. Same how material was having cost, price, usage, mix and yield. Similarly, here we will have labor cost variance, labor rate of pay or wage rate variance, labor efficiency variance, idle time variance, labor mix variance and labor yield variance. So if you look at your labor cost variance, the difference between the standard direct wages specified for the activity and the actual wages paid. And your labor cost variance is the function of labor rate of pay and the total labor hours or labor time variance. So it arises due to a change in either wage rate or in time or both. So labor cost variance is calculated. This is the formula. You can just look at here. means what is the actual wage rate we thought and what is the actual wage rate we are paying. The difference of these two is called labor cost variance. So time into wage, if you remember material cost variance, they we have taken price into quantity. But here it is not, it's not price we call it as wage. And it's not quantity, it's time. What is the time they spent and what is the wages they are receiving? That is standard wages into standard time minus actual time into actual wages. That is labor cost variance. So you can even just write like this formula. LCV, labor cost variance, is equal to standard time into standard wages or standard cost or standard time for actual output, okay, minus actual time into actual wages. Actual time into actual wages. So this is labor cost variance. Next, labor rate variance or labor rate variance. Labor rate variance is equal to actual time into standard rate minus actual rate. Here we take actual rate, we're talking about the rate. Whenever you're talking about the rate, you should take standard rate minus actual rate, and it is been done for the actual time taken. Taken for the actual time taken. So this is at labor rate variance, LRV or LPV, whichever you want, you can just take that. Labor rate variance or labor pay variance. Next, labor efficiency variance. Here we are talking about time. If you just remember, here we are talking about rate. So we have taken time as the, that is actual time, whatever taken, into standard rate minus actual rate. Now we are talking about efficiency. Here we take actual quantity into standard time minus actual time. You just look at it. Labor efficiency variance. Standard wage rate into standard time for actual output minus actual time taken. So what is the standard time given minus actual time into standard wage rate will come the labor efficiency variance. Just look where we will look at the one or two problems to try to understand the labor variances. Calculate labor variances from the following information. Under that we have gross wages direct. This is the gross wages. What are the wages we have? Standard hours produced is 8,640. Standard rate per hour is 3, that is per hour. The standard rate is 3 rupees. And actual hours worked is 8,200. But they have not given actual rate. Yes. So total how many wages they have been paid? That is 28,080. So we can find out the total amount divided by number of hours spent. So we'll get. Just look at your labor cost variance. Labor cost variance is equal to standard labor cost minus actual labor cost. So what is standard labor cost? Standard time into standard rate minus actual time into actual rate. So standard time is 8,640 hours and rate is 3 rupees. But actual time is 8,200. Do we know the rate? No. What I said, total, what is the gross wages they are receiving? 28,080. So actual rate is equal to gross wages. What are the total wages they are receiving? When that is 28,000. That is 28,080 divided by what are the actual hours they are working? 8,200. 8,200. You'll get the actual rate. So your standard labor cost is 25,920 minus actual labor cost is 28,080. So we get an adverse, that is 2,160. Next, labor pay time or labor rate variance. Labor rate variance. Whenever you call rate, rate should be standard rate and actual rate should be done with the actual time. So standard labor rate is 3 rupees and here whatever we did now actual rate that is 3.42. So here we implement actual time is 8,200. Standard labor rate is 3 rupees minus actual labor rate is 3.42. It's incurring more. So again you will get adverse 0.42 into 8,200. 3,444 is the adverse of labor rate variance. Next we have labor efficiency variance. The formula is here whenever we talk about efficiency, we will take consider the time as the base and for that we will do it with the standard labor rate. So your standard rate is 3 rupees and hours time taken is whereas standard is 8,640 whereas actual it is 8,200 only. Very less time they have taken. So here we get favorable that is 3 rupees into 440, 1320 is the favorable. So this is how we do labor cost variance, labor rate variance and labor efficiency variance. And this is labor mix variance. Labor mix variance is equal to standard cost of revised standard labor mix minus standard cost of actual labor mix. And this is the labor yield efficiency. Standard labor cost per unit of output into actual yield minus standard yield for actual output. So like this, some questions may be given like this, like categories like skilled, semi-skilled and unskilled. Skilled, semi-skilled and unskilled. Under this we have standard number of workers and weekly wage rate per worker is given. Actual number of workers and weekly wage rate per worker is given. So we'll just try to find out like this labor cost, standard labor cost and actual labor cost and implement in the formula. Similarly, we do with the overheads also like this only. So this is variable overhead variances. Under overhead variances, these are overhead means nothing but there are expenses which are incurred indirectly are called overhead expenses. So under this we have variable overhead variance. Similarly, we will plan this would be our cost which we will incur, but when we, in actual it may be different. So whatever the difference we get between the standard and the actual, that we find out with the help of variable overhead expenditure. The formula is actual hours into standard variable overhead rate per hour minus actual variable overhead. Otherwise, you can simplify it by actual hours into standard variable overhead rate minus actual variable overhead rate. Next, variable overhead efficiency variance. The formula is standard variable overhead rate into standard hours per actual output minus actual hours is. The next topic is budgeting and budgetary control. So under this, we have different types of budget as we know that budget is nothing but estimating for the meeting the future expenses or the future requirements, what we are going to meet with the current available funds, we call it as budget. So in the business also we have different types of budgets like sales budgets, production budgets, cost, material budget, cash budget, flexible budget, variable budget. So that all we try to understand. First, we try to discuss the format, how actually budget looks like. Just give me a second. I am sharing the format. So we have different budgets that are available at the organization level. And if you can just look at it, there are certain steps which are very necessary for the successful implementation of budgetary control system. That is organization for budgetary control, budget centers, uh, budget officer, budget manual, budget committee, budget period, determination of key factor, what are the things that will come across while preparing the budgets that should be aware in advance. Why? Because we prepare, for example, we need working capital. As a business, we need working capital which for to carry out the operating activities of the business, without which it's not possible. So what is the working capital you are going to maintain? What is the cash that is available with you? So here, if you look at their classification and types of budgets, these are commonly used as classification according to time, classification on the basis of functions, classification on the basis of flexibility. So classification according to time, we have long-term budgets, short-term budgets, and current budgets. And based on functions, we have operation budgets, financial budgets, and master budgets. Classification on the basis of flexibility, we have fixed budget and flexible budget. So just look at that. We'll look at the budgets and we'll try to do one or two. We're talking about the flexible budget. Yeah, okay, fine. We'll go with that only. So operating budgets, we have sales budget, production budget, production cost budget, purchase budget, raw material budget, labor budget, manufacturing expenses or works overhead budget, administrative and selling expenses budget. So program budget and responsibility budget, like financial budgets. So under the financial budgets only we learn a lot. So classification on the base of flexibility. Here we have fixed budget and flexible budget. Flexible budget means which will change as per the requirement of the situation and the circumstances. Whereas fixed, it will not change. In flexible budget, we have expenses like cost classification like variable, fixed cost, variable cost, and semi-variable cost. Here, fixed cost means there are certain costs which will not change to the extent, will not change with the change in the level of production. And whereas variable cost is the cost that will change with the level of production is called variable cost. Then what are semi-variable costs? Why? Because these are very important when you are doing the flexible budget. Without this, you cannot understand what actually flexible budget is. Because flexible budget is nothing but the sum of fixed cost, variable cost, and semi-variable cost. Flexible budget is nothing but the sum of fixed cost, variable cost, and semi-variable cost. Fixed cost means the cost which will not change with the level of output is called fixed cost. And variable cost means the cost which changes with the level of manufacturing or the number of units you are producing. The variable cost also changes as per the number of units we are producing. The next one is semi-variable cost. This is the cost to some extent, to the level of some level of output, it remains fixed. After that certain level, it goes on changes as per the number of units you are going increase. That is called semi-variable cost. Now, if you just look at here, the expenses for the product, this is, I think, flexible budget they have given. Let's see. The expenses for the production of 5,000 units in a factory are given as follows. So, how many units? For 5,000. If you are producing 5,000 number of products, the cost what you are going to incur is given over here. Materials is rate is 50 per unit, labor 20 per unit, variable overheads 15 per unit, fixed overheads 50,000, whether the unit is 10 rupees per unit also, but it remains 50,000 only. Administrative unit expenses. If you just look at here, what is telling administrative units expenses, cost per unit is 10 per unit, but 5% variable is still 5% variable. It means administrative expenses are 100. In that, 95% are fixed, 5% is variable. Means in this 10 rupees, 5% is variable, 95% is fixed cost. Similarly, these are called semi-variable expenses. These are called semi-variable expenses. Let's just look at your selling expenses. 20% fixed. Means what about 80%? That 80% is variable. It changes. So this is also semi-variable expense. So in the 6 rupees, 20% is fixed. Remaining 80% is semi-variable. That is variable. Similarly, distribution expenses. In this distribution expenses, what is telling? 10% is fixed. Means in this 5 rupees, 10% is fixed. Remaining 90% is variable. So these three are semi-variable expenses. Means to some extent they are fixed, the other extent they are variable, they are changing. These three are semi-variable and these three are variable, which will change with the number of units you are producing. For example, if you are producing one chalk piece, you will require one box of powder. If you are producing two chalk pieces, you require two boxes of material. So like that, these three will change as per the number of units you are producing. These are called variable cost. These are called variable cost, which changes with the number of units you are producing. Next one, fixed overhead. This will remain same. There is no change. This is called fixed cost. Now, these all are given for how many number of units? This is 5,000 units they given. Now, you are required to prepare a budget for the production of 7,000 units. So, for how many units you need to prepare? This is called flexible budget. Now, look at here. For 5,000 units, for 7,000 units. First, let's see these rates. No, these rates are very, very important for us. Yes. If you just look at here, these rates remain same because units will change. This rate will not change. So material 50, labor 20, variable 15. Let's see. Material 50, labor 20, variable 15. Yes. Here also for 7,000 units also it remains material 50, labor 20 and variable 15. Only thing is 50 into 5,000 units, 2,50,000. 5,000 into 20 rupees, 1 lakh. Similarly, 50 rupees into 7,000, 3,50,000 here. 50 into 7,000 units, you'll get 3,50,000. Similarly, 20 into 7,000 units, 1,40,000 units. Similarly, like that for all variable as well the semi-variable will changes. The others will not change. So like that they do it, and this is how we get the total cost of sales under flexible budget. Under flexible budget. And the remaining budgets we continue it in the next class. And the remaining budgets we continue it in the next class.